Hey, if you're looking to create a set of financial projections for a gym, then you have come to the right place. So whether this is for a potential SBA loan application or maybe potential investors and you need to put together a set of projections, or even if it's just for internal planning, this template is going to be a good fit for you. So we have put together a template that's going to give you 5 years of a projected income statement, cash flow statement, and balance sheet, broken down by annual and monthly level detail. We're just going to provide everything you would need in terms of what a SBA lender would be expecting or even a potential investor would look to see. Now, this particular template is kind of our generic gym template. And you'll be able to see as I walk through it how you can use it for membership-based gyms, as well as kind of class-based or personal training-based gyms. Kind of any mix of those should work well with this template. I'll show you how to fill it out. So before I dive into the details of the template, just a couple of details. One, if you go to the description of the video below, you'll be able to find a link to the template so you can grab that and follow along as you go through the process here. And the second thing is, if you stick around to the end of the video, as our thank you for sticking around and hearing me talk through this, maybe not the most exciting spreadsheet topic here. As a thank you though, if you stick around to the end, we are going to give you access to a discount code that you can use to take a discount on this particular template. And then the last thing, before I dive in here, just a little bit of background on me. So I spent a little over 12 years as the executive director of an SBA lender, and we made over 1,500 SBA loans during my time there. And so I come to this process of creating projections with that kind of lender hat, that lender perspective. Also, many of our clients that were getting a loan were also raising capital from investors, and so we kind of have that experience on both sides here. So with that out of the way, let's go ahead and dive into the model here. So I am starting here on the at a glance tab, and this is kind of the end of the process. So after you filled out all the input assumption tabs, you're going to see an at a glance tab with a profit and loss at a glance and some other key ratios, some key data points, KPIs, things like whether you're breaking even or not in the year, how many members you're going to need in order to break even, what's your annual churn rate of members, customer or member lifetime value here. So key metrics that will be important to you as a gym owner. We'll also have some other graphs and tables here that will be helpful to put into a business plan or into a pitch deck. So you'll also get a 5-year income statement summary, 5-year cash flow summary, a 5-year balance sheet, and then that income statement, cash flow, and balance sheet all broken down by month for each of the 5 years. So that's the end of the process. Let's start going through kind of the input assumption tabs here step by step. So the first thing you need to know is that any assumption in blue is an assumption that you can change without breaking anything in the model. So I've got Adam's Gym here. We're going to start in January 1st start date. For the opening cash balance, if we're going to assume in this example that this is a startup and that you haven't started yet, so you don't have cash in the bank right now of the business. Let's say you are going to make a personal investment into helping start the business of $25,000 in month 1. So if that's something you haven't already made that investment, then you'd want to put month 1 here. If you have already received investment or already made investment in the past, you could put month 0. All right, so on the accounts receivable terms, this you can probably just leave this the way it is. This is basically just saying, hey, you're going to get paid when you provide the service. So you're not going to let people come to a class or, have a whole membership and then pay at the end, like at the end of the month or something like that. You're not giving terms to your customers. You're probably having them pay upfront when you provide the service or at the beginning of the month. Now on the accounts payable side, this is when you pay your bills. So here you might have some expenses that you put on a credit card and then you pay that credit card off at the end of the month. That's a perfect example for this kind of 20% here that maybe some of your expenses are paid on 1 month delay, but let's say most of your expenses, 80% are going to be paid in the month that the expense is incurred. Let's say you have some inventory, so maybe some merchandise, protein powders, snacks, drinks, that sort of thing. You can have some initial inventory here. And then I would probably just leave this 10% here, because what this is going to do is just make sure that you have some inventory on the balance sheet each month, and it kind of automatically replenishes. And as you grow, the amount of inventory that you need will also probably grow. And so we'll just kind of if you make it a percentage, it'll automatically grow with you. Fixed assets. So let's say you are leasing a space, but you need to do $25,000 of leasehold improvements. So that could be, painting, that could be putting up a new wall, that could be, laying down some new flooring, those sorts of renovations or remodeling. That's what you'd want to put here. And then if you have some gym equipment, you have $50,000 budgeted for gym equipment. Again, we put that all in month one. We put a life expectancy of 10 years, meaning the equipment or these assets are going to depreciate over that 10-year life. And then we have an SBA loan down here of $75,000. You can set an interest rate and a term here. And then ultimately, this table is going to tell you, after you fill all of the other assumptions out, your revenue and expenses, do you have enough cash to break even? Do you have enough? Is your cash sufficient? So let's go ahead and look at our revenue tab here. So based on the size of your gym, you might be able to estimate how many members you think you'd be able to have, kind of maximum number of members. So we set that at 800. And then for a monthly advertising spend, let's say we put in a monthly ad spend of $500. We think it's going to cost $200 to attract one new member. So you can see then how many new gym members we're getting from paid advertising. So based on the assumptions we have in here in this example, not very many new members from the paid advertising efforts. We're assuming most of the new gym members are going to come from this line, the word of mouth, social media, organic search, that sort of thing. And so you'll also notice in this line that the first 24 months here, we have highlighted in blue, meaning you can, manually adjust how many new members you think you're going to get. And what we're doing here, we're assuming when you first start up, hopefully you've kind of built up, before you even open your doors, you've built up a following of people that want to sign up as members on day one. So let's say the first few months, maybe 75, 50, and 50 new members each month. And then maybe it kind of settles out more at a lower level, 15 members a month. But then in that second year, we hit January. Everyone's got New Year's resolutions. They want to hit the gym. And so we expect, hey, we're going to jump back up to 75 new members in the month of January and then kind of trail back off to a normal level. Now, what we do going forward here in month 25 and in the years following, you'll notice it is following that same seasonal pattern. So it's looking at the same month of the prior year, using that as the baseline for the new members. So it'll follow that, January seasonal pattern. But we actually have here a negative 10% growth rate after month 24. So the idea here is that over time, it's going to be harder and harder to find new members. Kind of all the members that would be interested in coming to your gym have now heard about you. And so you're kind of saturating the market. And so over time, it's probably going to get harder to actually bring in new members, and we'll kind of reach that steady state of members for the gym. We also have a churn rate. So this is the percentage of members each year that are going to cancel or leave. So we set that at a third here, 33%. And then this row is going to calculate, based on your churn rate and the new members you're getting, how many active members you have each month. From there, you can set your different membership or service types. So let's say we've got an annual membership, a monthly membership. We have a pay per class option, a class pack option. So this could be for like yoga classes or group fitness classes, boot camp classes. And then you can have, one-on-one personal training as an option here. Now for personal training, pay per class or monthly, you'd want to put in 1 month for the period. For annual, you'd obviously want to put in 12 months. And then for the class pack, you want to estimate how many months you think it's going to take for the average person that buys a class pack to utilize those classes. So we're saying six months here on average. Now, we put in our actual different membership plans, because you might have multiple annual membership plans, right? Like you could have a membership type that is annual, but you could have like a, kind of unlimited annual membership plan and maybe a more limited basic annual membership plan, but they could still both be annual. And so that's the reason this kind of feels repetitive here, but that's because you might have, multiple monthly plans, multiple annual plans, and different price points. You can set the price points here, and then the percentage of regular members or users that are utilizing each of these services. Now, you might add this up and think, okay, this should add up to 100%. But if you look, it actually adds up to 110%. And that is on purpose here for this example's sake, because we are assuming that maybe this personal training, this extra 10% of personal training, that's above and beyond. So it might be that you only do personal training for somebody who has an annual or monthly membership. So that's really like an add-on. So you'd really expect, this group, these first 4 buckets here, to kind of represent the 100% of members, and then personal training is kind of an add-on from there. You could really think of it, could be that classes are an add-on as well. So it might be you have membership as a base, and then classes are even above and beyond that as well. So there could be some reason why this should be over 100%. From there, you want to say how many classes or sessions are going to be attended per month on average for each of these levels. We can set a 2%, or we can set an annual price increase. And then down here, you'll notice we can set the average spots per class. So what this is going to do is, based on these assumptions up here, we are going to know how many class spots are going to be utilized. So in this first month, 705 class spots. We have 25 spots per class. So that math works out that we need 6.5 class times per week in order to have enough slots open for that. Now, something I really want to point out up here, this total cash collected versus total membership and class revenue. So you'll notice that cash collected is much higher than revenue. So this is an accounting thing. So tune out if you don't care about the accounting, but I think this is important from a cash flow perspective. So when you have annual memberships, you're going to collect all of that cash up front, or even with class packs that are going to be spent over a 6-month period, you're going to collect the cash up front, but you are not going to earn the revenue all at once. So we're collecting in this first month $43,000 in cash, but we're only earning $10,500 in revenue. So the way you're going to earn that revenue on any annual membership, the way the model is going to work is it's going to have you earn that revenue 1/12 at a time, or if you had a quarterly plan, it'd be, every month for that quarter, you'd earn 1/3 of the total revenue for the quarterly plan, right? So it's going to prorate across the period of time, and you're going to earn that over time. So that's the reason there's a big difference here between cash flow and your net income or your revenue that you're actually earning. So keep that in mind. Cash is king here. So you want to make sure that cash flow works is kind of the first priority, I think, and then looking at whether how the net income looks is kind of secondary here. Okay, so you have other revenue here, food and drink. You could have merchandise or other, just kind of a catch-all other revenue. You can set, what percentage of your users or regular members are going to buy food and drink a month, how often per month, what's their average purchase amount. And so we have, kind of an immaterial amount of revenue in for both of those buckets here, but it is something you may want to model, or maybe more material in your business model. Okay, so that is it on the revenue tab. On our other expenses tab here, so you might have some opening marketing expenses here, let's say for just the first 3 months. Then the rest of these operating expenses might be more monthly expenses. You'll notice in year 2, these numbers increase. It is applying a inflation rate. So you want to be aware of that. The other thing to note is you can set expenses as a fixed dollar amount or a percentage of revenue. In this case, we're going to have this as a percentage of revenue here, 3% for credit card processing fees. We also have, I want to draw your attention to this class coach commission or instructor commission. So if you have a class-based gym and that's maybe the classes are primary revenue driver and you're paying a commission on that. Now, keep in mind, this is a percentage of total revenue. So, you be careful with how you utilize that if you are going to use a commission type structure here for coaches or instructors. All right, so you can also enter in salaried positions. So if we want to say, okay, we're going to have these coaches here, they're going to get a base salary of $45,000 annually. maybe some benefits, maybe not. Here's what month they're starting, and then how many of that employee do we have. So in this case, we're saying we're going to start with 2 coaches in month 1 and a front desk worker. And then in month 13 here, we're going to add a marketing director and a gym manager and some other part-time coaches and so on. So you can kind of see how you can layer in and grow your staffing over time. And you can provide an annual raise here as well. Okay, so that brings us back to where we started, our at a glance tab. So yeah, if you need help filling this out, if you've gone through that and you're like, you know what, I just want somebody else to fill this out for me, that is something that we can help with. We have a template fill out service, so feel free to reach out to us at support@projectionhub.com. We'd be happy to help you with that if you would like. We're also happy to just answer any questions that you have. So again, reach out to our support email address. And then as promised, as a thank you for sticking around here to the very end of the video, wanted to give you access to that coupon code. So if you go down to the description of the video below, there'll be a link to a form. You want to fill out that form, and we are going to email you our most up-to-date and current discount code that you can use at checkout when you buy this template. So that's our thank you to you. And if you thought the video was helpful at all, we'd love it if you subscribe to the channel, like the video. That really helps us get the word out there. So we appreciate that and happy to help in any way we can. All right, thanks.